Hey everyone, welcome once again to our weekly macro review. I think we have not talked for quite some time here. It was a summertime travels and personal engagement, so I think glad to be back here. While I think the markets have been pretty much like kind of extreme, maybe we'll talk through this. One of the, I would say, most violent period we have seen in recent times, especially when we talk about tech stocks, which most of us are, I think, pretty actively trading, and as well as I think the whole sector, which is basically the semiconductor, the AI, all of that. I would call it as pretty much uh, very, very, very tough times. That's what we can say. But why is it? Like, let's double click on it and how to build plans around it, because it's not going to be easy. Market is not giving easy crumbs. Like we had a huge rally from March, April, end of March to maybe let's say for a couple of months. It went away too fast. A lot of people were wondering whether we are in a bubble. We consolidated, and now we are seeing a kind of deep correction in tech stocks. So I think we'll start. Let me share the screen as we usually do. And again, as usual, we are doing this here in YouTube, but we do have options to comment. So feel free to ask questions and so on. We can have a discussion after we go through some of the aspects which we want to talk about. So let's go into the charts just so that we can do the usual discussions around, like, just a bigger picture view. So as I said, I think we are talking after a long time. And if you look at SPY, and as even in our the weekly update which the team puts together, as we mentioned, it will look like it's very, very calm markets. SPX is kind of flattish for quite some time now, trading in a small range. So I think nothing much to talk about it, but I think the real action is happening in the next Nasdaq. So as we did say, let's focus a little bit more on Nasdaq today, because that has been the story of last I would say month or so. After this whole rally, which we were tracking earlier, in the sense that it was kind of blowing up, there were some extremes. We did talk through how the semiconductor was going through an unprecedented non-stop run, which was like never before kind of a rally. What happened here is that it really kind of crashed in a way, you can say. Some of the biggest drawdowns, you can say. And also from a Nasdaq perspective, the monthly drawdowns were big. Like it was not like your usual corrections. It was not wide enough. It was very focused. So, and I'm sure a lot of people are talking about the situational awareness. It's a very big hedge fund, and the reason I say it is very big, I will go through that. What is the impact of that fund on what happened in last couple of days, especially with the kind of liquidations we saw on Wednesday, and then the recovery on Thursday. So it's pretty interesting what is going on. But also this showed you, it is culmination of why these markets are so difficult to trade, because the leverage, the size of the funds which are trading across, they are really becoming bigger and bigger. So before we jump into that, I wanted to just show, this was a great chart which came across. Just to put the context, I thought, let me go through that. So basically, when you say that, oh, there is a 100 billion fund or 20 billion fund or whatever, in terms of amount of money, because it's not easy to understand the impact of that without understanding what are the numbers. So even when we say that we have a regular buying in passive funds in US, you see 437 billion is the amount which went in 12 months, ending 30th June. And I'm talking about one of the very, very big rallies of all times happened during this time. And as you know, passive investments don't care about it. But what is the size? What is the size of these money which buys the stocks when you see trillions of dollars of market cap moving? It is not a huge amount in equity. Of course, there is sector equity investments. For example, AI attracted a lot. So active and passive, pretty significant sector investments happening. So these are like 400, $500 billion numbers. While there was a huge amount of active money, active management money was going out of the fund. So net, it's very interesting to see that US equity did not see much inflows while the market was going up. So as you can see, you're talking about very, very specific, and we have been discussing this quite a lot. The most of the investments were in sectors. And which were those sectors? Mostly AI-related sectors, semiconductor being the key, which attracted a lot of inflows. And again, just look at the size of it. These are not huge numbers in billions. These are like 100, 200 billion level numbers. Now, when we talk about situational awareness kind of a fund, which is basically a 20 billion fund which grew to 45 billion, it's not a small number when you look at the total inflows and one big fund liquidating. So a lot of people are asking me, oh, what's the big deal? It's a trillion, multi-trillion dollar market cap of each stock, which we are talking about, the AI stocks. The reality is that the inflows are not that big. And when a fund of the size, to 30, 40 billion, and remember, they were basically on margin. So when you bring in cash of 30, 40 billion, the not everybody, all the other inflows are passive inflows are stocks. They are not buying it. And so these guys have a outsized impact on how the stocks go up and down. And I think that is one thing which we need to understand. Now, what is the other aspect? Now we looked at, of course, I'm not blaming situational awareness or for all this rally. Then the other part you must be hearing in the news is the Korea leveraged funds and Korea. Again, this is not your typical buy and hold stock ETFs. These are leveraged ETFs. So it's very similar to what situational awareness was doing, very similar to, and unfortunately in last 1 year, this 2x, 3x, 4x ETFs have been growing. And again, look at the numbers here. The amount of AUM, that means the amount of money which was going into these. Of course, this is not inflows again, this is market cap. So I'm sure some of these funds were purely the gain in price and the crash, but still we are talking about tens of billions of dollars. So now combine these two together, what we're talking about is almost a leveraged effect of, almost $100 billion. And that's what has been happening, like, in last 1 month. So this is why the moves are bigger. Some of the stocks, if you look at semiconductor, and within semiconductor, I think the high beta stocks, like if you're an investor into AMDs of the world, for example, or AMD is not even that big of a move, I would say MU of the world, which is there are fundamentals. Of course, the memory is doing great, but and also the memory like outlook has been only going up. But how do you trade this? How do you trade a stock which goes up from 400 to 1200 and then comes crashing down to 750? I think this is purely because of the leverage, purely because of how much it is not about somebody saying that today most of the investment bankers and analysts are telling you that the fair price of MU is probably $1,500 and the stock price is the kind of recommendations they're sending is that minimum is 1100. If you look at any investment bank today, they're claiming the MU year-end target or whatever is 1100, 1200 or 1500, all the way up to 2000. So what I'm trying to highlight here is this is not a normal market. This is not a market which looks very calm from SPX perspective, but when you look at amount of leverage going into tech stocks, same thing was observed in what we saw in something like Google, for example, like a stock like Google and one of the biggest market cap. This was trading at 375 not long back. We are talking about 10 days ago, 15 days ago, and then within 4 days or 5 days, it goes down after, especially with the use of earnings as a trigger, where there's even more leverage. So what happens is one thing is already the market is leveraged, and then around earnings, you will see that more and more people start playing the earnings, and that creates additional leverage in the system, and the stock goes down from 375 to 315, and then it recovers back. Now, again, what is happening here is fundamentally, if you cannot trade on news, you cannot say earnings are good or bad. It's all about money flow. It's all about what is really happening in this market. So just wanted to cover, I think, my views on what we are seeing in this market and why we have to be careful. And we will talk through this and we will have a discussion. Of course, as I said, you can also add your questions as in the chat if you want to discuss what you're thinking. But let me just continue on the overall idea that what is really happening here is it is not straightforward. It is not going to be easy market, and you probably have to have convictions. Like stop losses will not work in this market because you will get liquidated. Like if you are a Google investor, if you are a MU investor, or any kind of stocks which are like moving in this range, the ranges are becoming bigger. And you cannot sit and like same thing is happening with Meta or Apple. Like Apple had been going up and suddenly after earnings you saw a big move down. So what I'm trying to highlight here is you're not going to be able to implement the usual strategies of that you can play according to a stop loss or support levels where you can get out of the stock and so on. So we believe that in this market is changing very fast. The question is whether this liquidation and the recent changes in Korea, does it help? Of course, it helps because it's a cleansing exercise. It is something when you have too much leverage and too much one directional moves. These kind of things help set, I would say, a little better controls. People do realize that this was insane move, and I would say that is the only positive we can see out of this. Whether it is over yet, I don't think so, because I'm sure there will be a lot of other funds who would be getting happy that they did not get liquidated and they can even continue going high leverage because of the euphoria around AI. And I think you have to watch out for that. So what are the other factors we are watching? Of course, as I said, tech, you have to build conviction at a longer term. And while we're talking about tech also, let's look at what is really happening, like especially with the earnings gone by. It's interesting that the story is still the same. Story is the same, that the hyperscalers are continuing to tell you that they are going to keep, they are getting, very, very high spending. The spending has actually been increased. Big tech is going to be increasing their spending even more than what the estimates were at the start of the year. So basically, they are still more optimistic about AI. They are actually raising their forecast of capital expenditure. And the reason being, they are showing you that, you know what, we have a backlog. That means they have orders. And some of them, if you look at, go through their earning calls, they're talking about commitments, not just expectations, but these are commitments from their customers, of the order of, 4 to 5x in some cases, in terms of how it is going up from last year. So their visibility is improving. AI is real, as they are talking about. So the fundamentals are there. There is a reason why they want to keep investing. They cannot say that customer is asking for more and I'm going to spend less and not increase my capacity. So it's a catch-22 now. So the market is saying that probably it is hyped up. Probably these backlogs will get cancelled. The reason being, now we are talking about some 2 or 3 big spenders. We are talking about OpenAI, Anthropic. By the way, even they are claiming, when they are raising private money, they are claiming that they have very, very big backlogs, and their customers are willing to pay what they are charging. So I think, as we have discussed multiple times, it's a matter of valuations are definitely high. The expectations are high. If you look at hyperscalers claiming that their backlog is so high, so somebody has to pay this in the end to justify. Somebody has to make sure that these bills are paid, whatever they're spending, and the backlogs are actually realized, because these are still commitments, which I'm sure there are some exits or nothing. If nothing else, the theory is, what if OpenAI or Anthropic just crash and they don't realize their revenues, which they are actually committing. So that's where we are in the market cycle, I would say. So that's a tech story. And then we have the macro story. So macro, as we all know, the war is still continuing. In fact, it's getting worse. And what we are seeing in last 1 month, there's a big change. So again, we look at the whole July review. We did talk last time, I would say more than a month ago. We were concerned about the rates, but they actually were correcting. Every time they hit a new high, there was some hope that yields will come down. The oil prices went down as recently as end of June, and we had yields correcting. So right now, market is again panicking. And if you see, we are making new highs. So we have basically going down to some of the highs of, I would call it even last year. This is one factor which why it worries us, because we have been sitting in an AI boom. And this AI boom is not only very, very dependent on debt funding now, because free cash flow has run out. And if the cost of the capital start increasing, we are basically saying that this is going to be a pretty tough situation for most of the industry in terms of even from AI boom to continue. So definitely a concerning thing. But on the other hand, the kind of growth we are expecting with AI, or kind of, if you hear Kevin Walsh and some of the people who are dovish on the rates, they're talking about how the AI will actually be the cure as well for the inflation, because of the deflationary nature of technology. So I think that is something to watch out for. But definitely, if not the tech stocks which are worrying about this, there are impacts on Bitcoin, there are impacts on gold. And I think as we did talk about, in early part of this year in January, we did call out that it is very frothy. We were expecting it to go down, but of course, that was just a correction. But what we are seeing and we are concerned about is as gold is now trading below 200-day moving average, we do see that is it the factor, and I think most of it is because of the yields going higher and the dollar strength, you can call it. And that is actually becoming a worrying sign, even though it's consolidating above 4,000. So this is probably the last support, I would say. If we stick around 4,000 and we do not break down, gold is still getting bought, by the way. If you look at the demand, the fundamentals are still the same. But as we always say, the price are not determined by fundamentals, they're determined by money flow. Right now, the money flow is going out of the hard assets, whether it is Bitcoin or gold. The reason being very simple, that we are right now all in as a whole economy, as the whole world into AI. And that is what is the biggest part. That is what is playing out as we speak. That is what even the biggest companies of the world, like, as we always talk about the mega caps, everybody's betting on. And when you are putting so much money into one outcome, which is AI being successful, the other assets will suffer because these are, store of value, but you are right now basically chasing a AI dream. That is the reality of the world, that for the lack of better word. So for the lack of better words, I would say this is right now we are living in a all or nothing kind of a AI situation, and market is jittery about it, whether it is stock market or the assets which are, whether it is gold or silver, they are going down. So that's a reality of where we are. Now, when I say that, I also need to go back to the idea that fundamentally, it's very difficult because people keep coming and saying, "Oh, is it a dot-com style boom and bust? Are we done with this cycle?" So one thing I preemptively always say is it's very difficult because either you trust these mega cap stocks whose performance, especially their earnings, are actually still growing, even though I know that concerns are around their debt and how they're raising money right now for the AI spend and whether the spending is justified or not. But at this moment, their PE ratios are, forward PE ratios are, really, really cheap. So definitely does not look like .com from that perspective. I think what market is saying is, are these earnings going to be realized? Are the whatever the promises are, what if the customer disappears? I think that's either you are basically collectively saying that all of these are acting in a very irresponsible manner. You are talking about the people who have built this current generation tech world. You're talking about leaders of, Microsoft, Amazon, Meta, and Google of the world, and some of the biggest companies in the world. So it's a very interesting situation where right now there's a lot of skepticism while the fundamentals look on paper very, very solid. And we have seen this before. A couple of years ago, we had similar concerns. And every time market just realizes that they were overblown, and people get even more excited every year as the technology improves. And I think at this moment, my personal view is that AI is living up to the expectation in terms of following through on delivering and earnings. And I think it's anybody's guess if we have already gone too far or if this is the end of it. So coming back to that, I would say it's a very simple story now. If you believe the AI is really going to continue delivering the way it is, the market is very simple. We are getting a correction. You stay long, stay in the solid companies, you can probably see another big leg. Or I think we don't know whether the deleveraging is over. And if the deleveraging is not over, be prepared for wild swings, as I said, because definitely we are seeing the moves being bigger, and it's not going to be as easy a market. So that is, I think, all I wanted to discuss in terms of where we are. Again, as I said, very much the macro factor, as I said, to watch out for will remain the oil prices and whether the Iran conflict resolves, because that will definitely help the markets, because it was helping in late June when the oil prices were coming down, because there is one less thing to worry about. As I said, the yields are very critical. And if nothing else, it's about the cost of capital. And so why would you take risks into when we already talked about the technology risk and the unknowns? when you have a risk-free return going up. So money will definitely rotate out if this continues climbing. On the other hand, people who believe in the high growth ahead because of AI, I think the opportunity still exists with these kind of corrections. So I think that's where we are in this whole market cycle. So um, again, as I said, let me quickly check if there are any questions. Otherwise, I think we'll continue trying to do these more often. And I think it was a very, very crazy month again, as I said, July. We'll try to do again, as I think people are coming back from summer. I'm back now. So, we can also continue doing these and also try to host some in-person meetups as we used to do. So thanks a lot everybody for joining. And we are always, I think our goal here is that we look through a bigger picture view always. We look through what is happening. And as I said, a lot of people, and especially in this industry, especially active traders or people who are, and we have ourselves being very actively, managing the portfolios. It's not going to be easy because the market is going to whiplash on both directions. And we are very carefully watching if the deleveraging has reduced some of this extremeness. And we will keep coming back with more data as we see. But overall, um, just understand that sometimes there will be a lot more pain in this market because the markets are becoming like the moves are bigger. I mean, we are talking about $5 trillion companies moving by 10-20% in a day, or even like 20% in a week, or so that those are moves which did not happen before. We used to call them blue chip. We used to call them stable companies, but that is not because the company's fundamentals have gone down or anything. It's all about the market. The leverage volumes are growing so much, and the market makers, that's how they thrive on. They thrive on liquidating people who cannot control their leverage. So just watch out for, if you're playing on margin, if you're playing options, as we always do, look at analyzing your worst case. The good part is when you play in these kind of products, if you're playing margins or if you're playing options, the way it goes down, it also can work in your favor when you get it right. So as we always say in the hedge fund industry, that the one who survives, who doesn't get liquidated, wins. And it's not about short-term pains, it's about understanding what is a long-term path. So I would just recommend everybody to focus on that. So thanks a lot for joining here, and do send us your comments and feedback. Seeing you in WhatsApp, I think we are already having active discussions, and we will try to be even more active as the summer comes to an end. So thank you everybody for joining, and let's continue talking. Bye-bye.